let's bring in Tom Lee now, co-founder of Fundstrats Global Advisors and a CNBC contributor for more on the markets. Tom, good to have you with us. What did you make of today? I mean, you're a bull. Let's put that out there. Everybody knows that. But the failure to bounce today, did that make you rethink where we are in the markets in terms of market sentiment?
I think the market held up incredibly well today. This Evergrande is the biggest shock to hit financial markets since COVID. And in a way, it's scarier because it involves quite a lot of debt. And, an obscure world, I think as people look at Evergrande, it involves a lot of leveraged products and off-balance sheet and SPVs. And, so I think the fact that the small caps actually rallied today and the NASDAQ and the S&P managed to hold flat shows that the shock of yesterday was really the big impulse, and today is a little bit of the ripple effect. So I would say I think it's quite constructive, actually.
Okay, so you think it's constructive, but at the same time, for all the reasons that you laid out, why the market action was constructive, because Evergrande is this hairy problem that we have. We don't know how that's going to pan out. Isn't that a reason to be cautious about the markets longer term, since we don't know how this will play out, and we don't necessarily know either the impact on not just the Chinese economy, but even the sentiment of the Chinese consumer. Unlike our markets, the Chinese retail investor plays a big part in the markets over there. A lot of wealth is tied up in the markets from households, and losing a lot of money can really have an impact on the psychology there, and then therefore the economy.
Yes. In a way, yesterday was a big shock to equity markets. But as you know, if you look at financial conditions, they actually barely budged. Oil barely moved. The 10-year barely budged, and even currencies barely moved. So this was sort of a shock that hit equity markets globally. And as everything you've described, I think, is correct. In Asia, a lot of people have money tied up in property or digital assets now, much more than financial stocks. And if I think about what that kind of means is I think we're just seeing the aftershock of retail investors largely who've been negative. They've been withdrawing money from equities for 6 of the last 7 weeks, and AAII sentiment was the worst reading last week for all of 2020. In fact, the worst since September 2020. So you've got a really sort of cautious, nervous retail market that I think kind of panicked yesterday. Institutions, I think, haven't really dived in because they're expecting aftershocks, and they think if it's like long-term capital or Lehman, that it's going to take some while to repair. So I think in a way the markets being flat today is actually a pretty good outcome. So again, I think we're still in a position where I think ultimately stocks are going to rally hard off this, and it's ultimately because unless Evergrande is going to cause a real seismic effect on the U.S. economy, I think the U.S. fundamentals are in good shape.
Hey, Tom, it's Karen. Thanks for being on. So turning to the U.S. fundamentals, I mean, even though the market's not off that much, we had a lot of sectors, as Dan was saying earlier, that are really, commodities really getting hit, industrials, financials. If you're bullish, where of the sectors, what do you like?
We've been looking at this sector relative strength recently, and we're going to talk about that tonight. And I would say it looks like the market's actually trying to decide what's going to be a battleground, because I think FANG isn't as strong as it looks, and I think cyclicals like industrials and financials and generally domestically oriented companies are actually holding pretty well. So I think that this is a time where the market is waiting. Investors are waiting for the market to tell them where the strength's going to be. But our guess is that if the economy's continues to be in good shape, which is our base case, and COVID's retreating, then I think you really want to have a cyclical tilt into your end.
Tom, good to see you. Thank you.
Thanks.
Tom Lee of Fundstrat. Tim, you with Tom on the cyclical tilt?
I am. Well, if nothing else, just because of the underperformance. And I realize we may be looking at Q4 GDP that is not what we were expecting, maybe down by a couple hundred percentage points. But we had priced in, maybe this is the fourth wave. And if you're looking at Tom charts, they do a nice job in analyzing COVID and heat map, et cetera. I mean, there's no question we had the second highest crescendo in terms of in terms of infections about 6 weeks ago. And a lot of this led even into September. Cyclicals priced this in, I think, aggressively as we got into the second half of July. And I think a lot of that pain is something that's still going to have to be assessed. But ultimately, and we'll talk about FedEx in a second, but if you look at transports and if you look at industrials, the fact that the earnings power of a lot of these companies has never been better, that's the one place where I don't think we priced in normalized earnings and some actual upgrades we'll see.
I think that markets are sort of seeing this gigantic wall of worry, Carl, and I know people are talking about Evergrande and the spillover being like Lehman, but when I look at what yields are doing, which they're being quite tame, and the VIX isn't really as jumpy as it could be, I'm in the camp that this is going to prove to be a really good buying opportunity. Now, I heard Michael Santilla, and I agree with him. I don't think that means stocks find their bottom today or even tomorrow, but is the recovery that's only 1 year into over, or has the pent-up demand been exhausted because of some property woes in Asia? I would say no. So I would look at sell-offs like this, which is like sort of broad-based selling, as time to sort of add incrementally, only knowing that it may not be bottoming today.
Right. Of course, there's property in Asia. There's obviously the trajectory of the pandemic, which I know you follow closely. For others, it's about domestic policy risk and how the market absorbs the next couple of months of Washington. How do you think that happens?
Well, yeah, unfortunately, Washington is unpredictable. And, I know there's going to be a lot of headline risk. It's something Tom Block, our policy strategist, has talked about. But for investors, unless there's going to be, dramatic changes coming out of Washington, the debt ceiling and risks of a shutdown, while they're kind of scary and may cause headline problems, they don't really change where stocks will be 6 to 12 months from now. So again, I'd be sort of trying to take my lens, look a little further, and realize we're going through a lot of chop right now. But number one, I think we're going to finish strong seasonally. I mean, I think also September has a chance to really turn around. I think we're at a moment where everyone's only seeing sort of darkness and downside, and usually that's when you want to be adding risk.
Well, so Tom, tell us a little bit about that long-term bull thesis and how millennials and your expectation for how millennials are going to be spending plays into that.
Yeah, I mean, I think one thing that we have to keep in mind is I don't think there's enough of a focus on sort of demographic tailwinds that are being generated by millennials. And I think the first and foremost is, it's people aged 30 to 50 that really drive economic growth. It's so apparent looking at Chase credit card data or any of the credit card data numbers. And this number of people 30 to 50 is actually starting to accelerate because of millennials. And on top of that, U.S. household wealth now has hit 120 trillion, which is a staggering wealth level. But about 2 trillion of that is being inherited per year by millennials. And so over the next 20 years, millennials will inherit collectively something close to 70 trillion. So you have a sort of a 10, 20-year window where millennials are not only contributing to a revitalization of economic growth, but then their wealth is growing very quickly too. And that's a great combination for risk assets, especially stocks and crypto, because millennials generally are sort of buying disruptors, really into decentralized finance, and less interested in bonds. This is all great news for stocks.
It is, but are there any risk factors that you're watching, either whether it's about consumer confidence or other issues that could make those millennials less of a growth driver than what you're anticipating?
I mean, plenty can go wrong. I think the biggest risk is something that would cause the Fed to have to really take aggressive measures, and that would be inflation rising at levels that are uncomfortable. I just don't know what that level is. I don't think 2% or 3% is sort of the kind of inflation that scares people. And then, of course, the second would be some sort of exogenous shock. Now, that could be a commodity shock, like if oil gets to 200. Although 200 today is not really the same as 200 in 2008, or some geopolitical event. So, I mean, I think there are plenty of risks out there, and I don't think stocks are invulnerable, so they can always decline dramatically. But I think that the sort of structural tailwinds are in place for the S&P to rise for quite a long time.